So for those of you who couldn't hear us, there's the risk warnings. This is what we're going to be looking at, what President-elect Trump is thinking, what the market's thinking, themes to watch, some conclusions, and then into the questions and answers. So here he is, President-elect Donald Trump. He'll be officially sworn in on the 20th of January. What are the big issues that he campaigned upon? We won't go into some of the more grubby political elements of the campaign, even if some of that mud did clearly stick to his opponent. The economy and growth is clearly where the Trump campaign has resonated. Trade, again, linked to the economy and growth, the loss of American jobs. He is clearly going to try and promote onshoring as best he possibly can. Again, also tied into the economy, regulation, pharmaceutical industry, banks. He's looking at cutting back on the massive thousands of pages related to Dodd-Frank and banking regulation. Immigration is a hot one. It remains to be seen what he does there. He seems to be sticking to his promise to eject illegal immigrants while still in theory welcoming legal ones. And then energy and the environment, he's come across as being very pro-carbon, pro-oil, pro-coal. I mean, if you look at Denmark's Vestas wind systems, one of the world's biggest wind turbine manufacturers, its shares collapsed on the day after the US election result became known. I'm not sure wind is necessarily anti-green. I just think he's pro-energy self-sufficiency for the US. And if shale and oil and carbon are the quickest way to achieve that, I think that's the way he'll probably go. But again, it's pretty difficult to tell. As we know, he's just filling out his staff now with Vice President-elect Mike Pence. But those are the issues which seem to have particularly resonated with the electorate going in to the election, a new broom approach, a call for change. We will see now what he delivers over the next 4 years. But they've been the big issues which he's addressed and which the market has begun to associate him with, rightly or wrongly. What's the market thinking? Well, the first thing everybody always looks at is how does the market do under a Republican president rather than a Democratic one? As we can see, the market overall has done pretty well under Barack Obama as we were emerging from the great financial crisis. Do note, however, that as we can see here on the, generally speaking, the market has done better in the first year, the US equity market has done better in the first year of a Democrat president rather than a Republican one. On the average decline under those 9 Republicans is just under 2%. The average gain under those 8 Democrats is just over 12%. And in fact, on all 4 occasions since the war that we've gone from a Democrat to a Republican, Eisenhower, Nixon, Reagan, and George W. Bush, the Dow Jones actually fell in its first year. Now, this may be generally because Republicans are seen as a little bit more classically hair, shirt, and austere. I think it's fair to say that given what he said so far about $1 trillion of infrastructure spending and corporate tax cuts, that Bush isn't necessarily a classical Republican, that Trump isn't necessarily a classical Republican. So again, we must be a little bit wary of the lessons of history. The other thing, of course, to bear in mind here is that we need to also be aware of who's in charge of the House of Representatives and who's in charge of the Senate. On this occasion, Trump, it's actually a Republican grand slam of all 3, presidency, House of Reps, and Senate. Equally again, given that Trump is not a classical Republican, he's not a party insider, he certainly doesn't seem to have very good relationships with Paul Ryan, the Speaker of the House of Representatives, and the Republican Party is, let's face it, the House of the Tea Party, which is all about small government, less corporate and less government spending. Some of his policies may not resonate with the party which he's technically there to represent. So he still has to get any policies that he finally outlines through Capitol Hill. No guarantees of that. So again, we still don't quite know exactly what he's going to stand for, or once he's decided exactly whether it can be enacted. But that's something that historically the market is tending to fight a little bit shy of Republican presidents at first. Even Reagan, who's probably turned into the darling of president of markets over the long run. But at the moment, at least, Trump being given a warmer welcome, I think because he's not seen as classically Republican. So why is the market given the president a welcome, or what issues is it latched upon to? Well, again, the economy and growth, for better or for worse, for right or for wrong, Trump is being seen as pro-growth, pro-inflation, with corporation tax cuts, with this $1 trillion infrastructure spending plan. And as a result of that, you have seen a shift or a strong narrative develop since the election, which you've been able to see very clearly in the media and commentary, of away from deflation towards inflation, away from fears of a double dip or triple dip recession towards growth. And you've seen, therefore, in theory, a shift from bonds to stocks, from defensive stocks and sectors to cyclical stocks and sectors. You've seen the yield curve steepen, so the yield on long-dated government bonds has gone up a lot faster than the yield on short-dated government bonds. That tends to happen when the market thinks inflation is coming. And you've also got growing talk of or an acceptance of the fact that the US may add to its fiscal budget deficit on aggregate and an annual basis rather than try and shrink it. So that's been a massive shift, but to be fair, it only accentuates a trend that we've seen since the spring, and I'll come back to that. On trade, emerging markets have taken a hammering. Trump's obviously had some extremely trenchant things to say about Mexico, about China, but the dollar has gone up, and the dollar has gone up because if inflation goes up, people think the US Federal Reserve will raise interest rates, and historically a strong dollar has been bad for emerging markets. It makes commodities, a core export of theirs, more expensive, and it makes it more expensive for them to service their dollar debt. You've also seen emerging market bonds sell off, because if US bonds are offering a higher yield, people get a higher yield there and take less risk than they would having to chase yield in emerging arenas. And big trade agreements like NAFTA, TPP, Trump's had some very, very aggressive things to say there about not being interested, about looking to ignore them, ban them, repeal them. So I think while people are excited potentially about the infrastructure plan and the growth plan, the big potential negative is tariffs. Very economists agree on virtually nothing, but one thing that they do agree on is that the imposition of Smoot-Hawley legislation in the US in the 1930s and retaliatory tariffs and protectionism around the world made an already difficult situation an awful lot worse than it would have been. So that's, I think, a potential long-term negative where everybody's waiting with bated breath to see what Trump's got to say. Regulation, rolling back regulation, rolling back taxes, a Reaganite sort of strategy that was wildly popular in the 80s. It's clearly been welcomed initially right now by certain sectors like banks, insurers, and pharmaceuticals. Defence, Trump is seeing strong on defence. You've seen UK defence contractors like BAE Systems rise, but not as much again as the big infrastructure players like Wolseley, like Hill and Smith, like Ashtead, for example. And again, this issue of green, is Trump anti-green or just not interested? He's certainly pro-oil, pro-coal, and pro-shale. Again, you've seen big moves from the picks and shovels providers, the oil equipment and services companies who sell into that market. So again, just these are some of the things that we've seen. This is the run-up to the election, and as you can see, a gentle sell-off. I think the S&P 500 index, America's benchmark, fell for 8 or 9 straight days going into the election. The S&P 500 has since rallied, and bonds yields have gone up, the red line, and since bond prices are inversely related to yields, just as they are with shares, the price has gone down quite sharply. So that's just over the 3-month period leading up to the election and the 1-month period thereafter. And now we've got this growing conviction that the Fed will screw up its courage and raise interest rates on the 14th of December. Equity markets have received the new president with relative calm. The Fed has previously used financial market volatility as a reason for not having acted this year, for having pushed through none of the 4 bond interest rate increases it was targeting. It might, for the 2nd year in a row, slip one through in December. This chart on the left-hand side shows you Fed funds futures and the percentage chance of a certain interest rate being reached according to the market. And as you can see, there's about a 75% chance of a rate rise priced in now for that December meeting. And in theory, with the Bank of England still running QE, the European Central Bank and Bank of Japan still running QE, higher rates in the US could mean a higher US dollar. It's begun to motor again since I drew that chart even just a week ago. And again, a stronger dollar is something that we're currently seeing coming out of the Trump win. Similar patterns in the UK, equities rallying, bonds selling off. I mean, clearly bonds have moved an awful long way now. The bond yield, the 10-year gilt yield troughed at 0.53% in summer. It is now actually at 1.37 exactly as I sit here right now. So that is a very substantial move. Though it is worth bearing in mind that UK and US government bond yields are still below where they were a year ago, and share prices are virtually no higher than where they were 2 years ago. So there's been a lot of wheels spinning, a lot of volatility, but the overall trend has been fairly indecisive. So we have seen a shift in sentiment, but we're not yet seeing a decisive breakout by shares or a decisive breakdown by bonds, even if some can argue we may be in the early stages of that. And I think this is just to look at, again, looking at it on a more granular level, looking at stocks. Again, I've already mentioned some of the names that have done well here, and you can see just linking this back to the Trump policies. Miners have done well because they're seen as pro-growth, pro-inflation. Construction names like CRH, the cement company, and Ashtead are in the top 10 there over the week after the election. BAE Systems, I've mentioned defence, and Prudential, I've mentioned more lax financial regulation. And again, over the 3 months beforehand, fairly similar story. So funnily enough, although the opinion polls may not have been pricing in a Trump victory, it looks as if the financial markets have done a better job of sniffing it out. And that's by stock. This is by sector. And obviously there's been a lot of talk that Trump has started these trends. And that what I've done here, therefore, is actually I think that these trends really became apparent starting in the spring and really kicked off with the EU referendum vote in the UK on the 23rd of June. As we can see on the left-hand side, leading up to that vote, we were already seeing some of the inflation-type players like metals and mining leading the way, cyclicals like industrial, transports, and engineers. And then on the right-hand side, the things that were struggling, some of the more defensive areas, for example, some of the financials like banks particularly. What we've seen since the EU referendum vote is more leadership from cyclicals, but with things like construction, forestry and paper, industrials, and now banks creeping into the situation, with some of the expensive defensive, some of the stodges like food producers struggling. So again, I'm not sure that Trump has started these trends, but he's accentuated them. And I think the EU and this vote and this gathering sense of electorates being dissatisfied with austerity, dissatisfied with growth, dissatisfied with income inequality, I think it's focusing politicians' minds whether they see this as an opportunity or simply a risk that they're going to lose their own gainful employment remains to be seen. But I think you are seeing a move away from austerity towards a desire to look at other means of stimulating economic growth, not just monetary policy, which could potentially have created income inequality. So I'm not sure Trump has started these trends, but he's definitely helping to stoke them. So that's what's happened, which I'm really good at. The bit now is obviously more difficult because I don't have a crystal ball, but here it is anyway. Themes to watch going forward, and I think I've just touched on it now. I think populism is potentially a bit of a rude name for it. I mean, a bit snobby, but I think what you have seen is clearly electorates say we're not happy, and some politicians are doing a better job of listening than others. I think Theresa May is listening very clearly with her talk of infrastructure bonds, which we may find out more about in the autumn statement from Chancellor Hammond next week. And even after Brexit and Donald Trump, we've still got 4 key ballots coming up. Italy in December, the Netherlands in March, France in May, and Germany in October at the latest. And in all of those, with the Movimento Cinque Stelle in Italy and Beppe Grillo, Geert Wilders in the Netherlands, Marine Le Pen in France and the Front National, and Frauke Petry and the Alternative für Deutschland in Germany, you've got some up-and-coming upstart parties there who are tapping into electorate discontent and making their presence felt, and none of them are pro-austerity. And so certainly fiscal stimulus taking the lead from monetary stimulus is becoming a growing theme, and that is seen as that is all potentially pro-inflation, pro-growth, as is the Trumpian protectionist tariff agenda. If he does try and roll back the supply chain management and that globalization has brought lower prices to consumers, that could conceivably bring inflation. Equally, we still have some awesomely powerful long-term deflationary recessionary trends to address. Debt has not gone away. It's still getting worse, and Trump is actually talking about increasing it, not decreasing it, even though he lambasted Obama for fiscal profligacy during his reign. Demographics are inherently deflationary, as we've seen in Japan. The older the population gets, the fewer breadwinners we have, and the more people taking out at the other end in terms of benefits, the tougher it is for the economy, and you also tend to spend less when you're older to make sure the money lasts longer than you do. The dollar is inherently deflationary. It makes servicing debt more expensive. It makes commodities more expensive if they're priced in dollars. And although tariffs can be potentially inflationary, protectionism can potentially be very bad for growth, as we saw in the 1930s. And militarization could frankly go either way. It is a potential theme under Trump. It's a potential theme in Japan, where the South China Sea is a geopolitical hotbed right now, let alone what's going on in the Middle East and Southern Europe. But again, nobody really wants to see a war, let's face it, and that wouldn't necessarily be a good thing at all. But tariffs and protectionism are war without the shooting. Militarization is war with the shooting. So there are still some profoundly strong trends that will work against any growth program. And this is, of course, worth bearing in mind that Japan, since 1989, has tried zero interest rates, QE, a weak currency and fiscal stimulus in order, or even all four at once. Its Nikkei 225 index is still half what it was in 1989, and the Japanese bond, 10-year bond, is known as the widowmaker, because anybody who thought it was eventually going to blow up and the bond would rise massively in price fall has been carried out every single time. So this is, at the moment, still classically what we've seen in Japan, with huge rallies and huge shifts in sentiment, but long-run progress economically and market-wise be very difficult to achieve. So we've seen a clear narrative develop, but it's certainly too early to say definitively whether Trump is going to enact it or able to enact it without House help. So what does this leave us in terms of conclusions? Well, we're still, and I left my good friend the cockroach on the front of the presentation. You heard me talk about him in a lot more detail at the post-Brexit presentation back in the early autumn, with that portfolio designed by Dylan Grice to be balanced between inflation protection and deflation protection, between cash, bonds, gilts and income-generating equities. And I still think a barbell strategy, putting all of your eggs in one basket might not really be the right thing to do. It traditionally hasn't, and the cockroach has traditionally provided protection from that. Again, the past is no guarantee for the future, but looking at the cockroach now, equities have done well, cash has done nothing, bonds have done badly, and gold has actually done slightly badly post-Trump, intriguingly. So the market is still giving out mixed messages. You would have expected gold to have been very much stronger if there was a real sense that inflation was coming. So let's see. But I think in the end, my message is, nobody knows what the new president's going to do. Nobody knows what he's going to get, whether he's going to get it enacted or not. And that's potentially inflationary from him, but some potentially powerful deflationary trends are still at work. And we've seen what they did in Japan, which has made life very difficult. So if Trump succeeds, which is where the market action's kind of been for the last week, then yes, growth and cyclical equities, junk bonds and gold have historically been the right places to be. If Trump fails or actually goes down a different path, or goodness forbid he brings in protectionism and we end up tipping over into recession, you need to be on the right-hand side of the slide, if history is any guide, with things like sovereign bonds, which have just been hammered, with cash, which is doing very little, with income-generating equities, which have been hammered. I think, if anything, the message has been coming out of the Trump election is that long-duration bonds, yield-offering equities have just got expensive and overstretched, and volatility was underpriced as measured by the VIX index, which is trading well below its historic average. So I think that's probably been where you've seen such violent market action. We've now had a week of it, but we've obviously got an awful lot longer to go. And given that in the end there are still these end games, either end game could prevail. I'm not sure it will pay to be too dogmatic about one or the other, and that does lead out to a balanced portfolio, probably sitting somewhere between them. The other thing to bear in mind, just finally, is the ultimate arbiter of your return from any investment is the price or the valuation you pay for it. And I've got nothing against the defensive companies in terms of their dividend yield paying capabilities, but they had got very expensive, and we've seen it all autumn, even before Trump. Any man of disappointment, Unilever, Reckitt Benckiser, Shire, Devereux, the stocks got absolutely murdered. And again, the same with long duration bonds. The price potentially got a little bit over elevated in the short term. Looking at the US, and this isn't a pretty chart, I mean, it shows that the US stock market on a market cap to GDP basis, well, it's only been, it's really very rarely been any more expensive, and certainly it's only been up here twice since the 1970s, and that was in 2000 and 2007, and things didn't end very well then at all. Equally, you can say, well, look, excuse me, that lofty valuation is justified because US corporate profitability has never been higher. And if the Donald succeeds in cutting corporate taxes, stimulating growth, you would expect that to be potentially continuing. And if you look at the very right-hand side of the chart, you'll see that US corporate profits as a percent of GDP slipped for 3 quarters in a row. Now, that had never happened before without the US going into recession. The good news is, in Q2 2016, that number went back up again. So maybe, just maybe, there is a little bit of a growth tailwind for Donald to exploit. But US stocks, it's hard to pretend that they're cheap. No matter which way you slice them, PE, market cap to GDP, price to book, you name it, but you can argue that's deserved because these companies have never been more profitable or more efficient, and if you believe in future growth going forward, then that could carry things along even if interest rates go up. And it's a similar situation in the UK. UK market, very rarely been this expensive. When it got to these levels in 2000 and 2007, things went wrong very quickly, but again, corporate profitability in the UK is at record levels. albeit it's a percentage of GDP nowhere near what we're seeing in the USA. So, but equally in the UK, corporate profit momentum is stalling. I think it's fair to say. So you'd like to see some of that growth that we're hoping to see from Prime Minister May's plans, perhaps President Trump's plans, or certainly that the market's hoping to see. You probably do need that to follow through for the UK to make marked progress from here, because ultimately neither the US nor the UK stock markets are much higher than they were 2 years ago. So net, nobody's got a crystal ball. We don't know for sure even what the president-elect's going to do or whether he can enact it. So we need to be prepared for a range of eventualities and not just one. We're still waiting for Trump to outline his plans. And of course, although we know that Prime Minister May wants to enact Article 50 next year, we still don't know what Brexit's going to look like. We're still in a post-referendum, pre-Brexit world. For all of that, through elections, through referendums, we are seeing a shift in market narrative from monetary to fiscal policy, from deflation to inflation for now. And that's actually been running since the spring and not just since Trump's election. And in the end, other important factors must be paid attention to, particularly valuation. That will dictate your return. It explains why the expensive defensives have had a bad autumn, but there will be a level at which point they again may start to look like compelling value. And ultimately, given the uncertainty, I will said it before and I said it last time, if in doubt, do nout, because if you do something, you are incurring trading expenses, which will ultimately erode the value of your portfolio returns directly to you. So thank you very much for your time. I will now look over at my glamour assistant, Michael Tyers, and start having a look at what questions we've got coming through. And I will do my best to answer as many as I can in the next 10 or 15 minutes before letting you escape and go to about your lawful business. So let's have a look here. Do I think travel and leisure companies will be impacted by a change in presidency? Should I avoid investing in these? Well, they've actually not done that brilliantly in the UK, though there is now some anecdotal evidence from some of the travel and leisure players that a weak pound is attracting tourists to the United Kingdom. Conversely, a strong dollar might put them off, but equally stocks like Carnival have done pretty well. It's a strong dollar play. So I think it's all very much horses for courses. In theory, if the economy bombs along quite happily, it goes along quite happily, that should be good for travel and leisure play. More corporates, more consumer spending, equally rampant inflation, outpacing wage growth would crimp consumers' wallets and not be good. So I think it depends. I think in principle, growth is a good thing for travel and leisure stocks, for cyclicals in general, but you wouldn't want to see too much inflation or it would start to damage consumer spending powers. But a strong dollar, historically not bad news for companies like Carnival either. Is the safest thing with the EU exit and US election to keep my money in gold? Well, gold's actually at a 5-month low. So the US election hasn't done that much for gold. It popped on the day and gold miners went nuts. You had things like Centamin, Petropavlovsk and Polymetal up between 5 and 10%. They've since given that back. And the gold-silver ratio is always worth watching here. It's about 72 right now. From memory, gold at about $1,280 an ounce, silver about $16, $17 an ounce. If the market really thinks that inflation's coming, I would expect to see silver outperform gold, and that ratio sink towards its long-term average of 56. But yes, if you think that inflation is coming, the precious metals have historically been a place to be. Equally, I think the sort of slight rejection of the precious metals in the short term is because there is perhaps a sense that QE will be tapered in Japan, QE will be tapered in Europe, and that the Bank of England won't press for more QE once it spends the 70 billion that it is outlined. And if you think that central banks are actually showing more restraint on money printing, that's potentially bad for gold. And I think that's why perhaps again this narrative of move from monetary to fiscal has actually restrained gold and silver in the short term. But if you really start to see growth, you really start to see protectionism lead to inflation, then they might come back. But if central banks drop out of the picture, gold and silver may actually have a bit of a quieter time of it than they have recently. Now, we've had 1 or 2 questions about the quality of the audio, but apart from that, what have we got here? Are there any countries which we think of its markets most affected? Well, I think those who've been most affected immediately, I've talked primarily about the US and the UK because that's where I'm looking at our customer numbers, we know the bulk of your assets sit. But emerging markets have probably seen the most violent action, and that's bonds, currencies, and stocks. I mean, they've had a fantastic run. emerging markets underperformed 2012 to 2015. And I think because the valuations were so tempting, I think because it got to the point whereby the news was so bad it almost had to be good, emerging markets had a brilliant run in the first 8 or 9 months of the year. Because Trump is seen as potentially challenging for global trade and has called China a currency manipulator, has had some pretty stiff things to say about Mexico as well. I think they're the markets that people have been most worried about. Stock market wise, they've suffered. Bond market wise, I was actually just looking at some data. Malaysia, Brazil, Argentina have really been hammered. Emerging markets again suffering because of the strong dollar. The one emerging market that you might perhaps look at would be Russia. Now, don't get me wrong, this is not widows and orphans stuff. It's pretty wild out there. Corporate governance is poor. It's very prone or very exposed to the movements in the oil price. Russia's RTS index, if you multiply the oil price by 20, that tends to be where the RTS index trades over time. But if Trump is serious about cozying up to Vladimir Putin and even takes it to the extent whereby he begins to relieve trade sanctions, then Russia, oddly enough, is potentially a winner. Although with Trump being very pro-oil and pro-shale, if he makes it easy to explore and drill for those and increases oil supply, that could be a tug in the opposite direction. But Russia potentially is an emerging market beneficiary, but overall the market's verdict right now is that EM currencies, bonds and stocks are potential victims. Now, looking here at investment trusts, how do the prospects in investment trusts compare to US equities? Any suggestions? I mean, the trend in costs in terms of investment trusts and funds, OICs, ICVCs, however you call them, is generally down. I think what I would say about the US is that if you look, it's a very, very deeply researched, well understood, well-covered market. I'm not saying it's efficient, that would be wrong, because you just look at totally efficient. But I tell you what, active fund managers are finding it incredibly hard to outperform. You know, if you go to the UInvest website and pull up, US large cap blend equity active funds, you'll actually find a couple of trackers in the top 10, and they're a heck of a lot cheaper than the active ones. Now, I must mention Angel Ajudo, and forgive me if I get his name wrong, who runs Fidelity US Special Situations. His 1, 3, 5-year performance record is awesome. I mean, these things don't last forever, but he looks at a very small basket of stocks and then is very, very valuation driven. His record is good, and he's a very successful active fund manager in the US. But overall, actives are having a tough time of it, and trackers have actually done every bit as well in many cases and for a lot lower cost. That's something to consider. What I would suggest with the US investment trusts is the discounts to NAV have opened up recently, and I think it's always worth looking at how those stocks compare to their historic discounts to NAV. There's nothing extreme there right now, but certainly there's always one potential guide to look at. The NAV discounts are not absurd. In the UK, they're quite tight. In the US, they're not quite as tight as they have been. But I think, if anything, trackers in the US have been terrific. Obviously, the one caveat to that is if the market goes down, you're going to follow the market down lockstep. And if you look at the US market trackers, the biggest 5 stocks in the S&P 500 right now, if memory serves me correct, are Apple, Microsoft, Exxon, Amazon, and Johnson & Johnson. So you've got to be pretty happy with those 5 companies to feel really comfortable owning a tracker fund. Apple is almost a matter of fierce debate. It trades at a discount to the market. Is it ex-growth? Is it cheap? Is the services business undervalued? Is a key issue. Amazon's 2 of its last 3 sets of numbers have absolutely stunk. Costs have begun to grow again very quickly. It's a very expensive stock. You've got to believe the momentum. Exxon is clearly a big oil player. Microsoft's had a fantastic run as it's turning itself into a cloud company, but its core market of PCs isn't growing that strongly. And Johnson & Johnson is an expensive defensive. So you can make just as good a bear case for those 5 names as you can a bull case. So yes, if you want passive exposure to the US, you've still got to make sure you know what's in the underlying trackers there. How do you spell my name? Or just in case you want my email address, it's russ.mould@ajbell.co.uk, and you can then send me any more questions you've got. Corporate bonds, yeah, I mean, funny enough, junk debt, sub-investment grade debt, hasn't suffered that much. Government bonds have been marmalised, sold off very heavily in plain English. Corporate bonds have suffered a bit. and junk bonds haven't suffered much at all, partly because I think a lot of US junk debt is in oil and shale drillers, and Trump is seen as pro-shale, pro-oil, and therefore it may be easy for these companies to refinance themselves. The fund manager, I do apologize for it, was Angel Agudo, Angel Agudo of Fidelity. Sorry, Julian. Now, corporate bonds, there are still clearly risks there. I mean, if you look at a lot of corporate bond funds, their duration is quite long. Now, that means the number of years in which, in theory, all of the bonds mature in the portfolio. And generally speaking, longer maturity bonds have got a higher yield to compensate you for the risk because the returns are more back-end loaded. And duration measures the amount that a bond portfolio or bond price moves if interest rates move by 1%. The higher the rate duration, the higher the volatility of the price. And if you look at some of the Invesco perpetual funds that have been very actively run, or the Fidelity equivalents, they've generally been running, Invesco have been running short duration funds for some time. That's actually not worked out too well in the last 2 or 3 years. It's worked out brilliantly in the last 3 to 6 months. Fidelity under Ian Spreadbury and Sajid Vaid, they've been running longer duration funds, but have tactically reduced that because they did fear a bond sell-off if Trump wins on the back of the inflation positioning. It'll be interesting to see, if, say, the UK 10-year gilt gets to 1.5%, or the US 10-year Treasury bond gets to, say, 2.25, whether long-term buys start to emerge or not. And if so, that would probably provide some support to corporate bonds as well. If you see rampant inflation, that's clearly not very good for bond yields where they are right now. But equally, if you still see relatively slow growth, that will probably still see decent demand for corporate bonds. So again, it's all a matter of the price that you pay and the scenario that you price in. And there's been a lot of violence in corporate bonds. I still think as part of a balanced portfolio over the long run, they have a role to play if income is one of your goals. But I stress if income is one of your goals, and you can withstand short-term volatility. Is there something that, if I've read about US mortgage rates rising rapidly in the last week, is that something you should be worrying about? Well, I guess if you've got a US mortgage potentially, and I don't know how many people I'm talking to do, they are generally priced off the US 10-year Treasury. So if the US 10-year Treasury yield goes up, then that will start to affect variable rate mortgages. And yeah, I think it's a valid point, and this is why I stress the issue of debt hasn't gone away. Consumer debt in the US is still at very high levels. For subprime autos, it's at record levels. Corporate debt is going up. It's just crossed the $2 trillion level for the first time. And Trump is talking about increasing the federal deficit. If interest rates rocket, even if the Federal Reserve does nothing and bond yields go up, debt is becoming more expensive to service. So the market will the bond vigilantes will take action whether the Fed does or doesn't. And again, that's why it's not an open and shut case that more infrastructure, more inflation means more growth. Japan is obviously the poster child for that. But yes, if bonds really blow out and does make servicing debt much more expensive, that is a potential crimp on a US economy and indeed a global economy that has still got dollops and dollops and dollops and dollops of debt. Are there any other alternatives on the US equity side to tracker funds and special sits? All I tend to do there is, again, you can just do your due diligence on what's got a good long-term track record. I would look at least 5 years, ideally 10. Look at the fees, and if anything, what you're looking to do is find an active fund manager, if that's what you want, who's got a good long-term record, but actually had a wobbly year, because then you're probably getting in nearer the bottom in terms of their performance cycle. But I think in the US, with it being such an efficient market and well-broked market, but also a narrow one, where the 4 or 5 stocks like Facebook, Amazon, Netflix, and Google have been a big percentage of performance, if the market goes down, if those stocks fall, I think it'd actually be easier for active fund managers to outperform if they keep on going up. So you probably want to see those stocks run out of puff, and then it probably gets easy for the active fund manager. But otherwise, do all your usual research on process, style, resource, cost, long-term performance, and try and find somebody who's maybe had a wobble, and then perhaps get involved. So I think we're just about running out of pension funds. What should individuals be looking at regarding the pensions you hold? I mean, again, I think them. I'm not in a position to give direct individual advice, but I think my message there is none of us know. None of us have a crystal ball, and that's why balanced portfolios are generally best. Rather than thinking, oh look, Trump's going to be great for oil, I'm going to own 12 oil drillers. Well, what happens if we're wrong? Then you're clearly going to suffer some extreme portfolio pain. So I think that, I always talk about the cockroach. It probably had a bad week, but that balance between cash, gold, equity generating income and bonds means that most scenarios should see something trickling into the pot. And over time, you would like to think, that the record of that portfolio is pretty good. The past is no guide for the future, but a balanced portfolio, yes, by all means, have a portion of your portfolio that you yourself run quite actively, if you wish, knowing that that's going to cost you money, which is eroding your portfolio return, so don't overtrade. But if you want to have a tactical position, please do, and then that's where you can maybe play around. But your core portfolio, you probably want to touch it as little as you possibly can to avoid dealing fees, possibly tax, depending on the wrapper that you hold things in. And again, that's where you probably have a balance to prepare yourself for any eventuality: growth, inflation, recession, deflation, because none of us know what's going to happen. But long run, a focus on income and reinvestment of that income has generally worked out for the best, albeit with periods when even that hasn't worked out very well, for example. And I think that is about it. Now, I've taken up about 40 minutes of your time, for which I'm enormously grateful. So thank you ever so much. We will send you the feedback forms. They will give you a chance to ask follow-up questions. But again, marketing@ajbell.co.uk or russ.mould@ajbell.co.uk if you want to ask any questions immediately or directly. And I would imagine we can probably make the presentation available for those that want it as well. So again, ask us and we can send that through. It's all been through the relevant authorities here, and it's got all the appropriate disclaimers in it. So thank you very much for your time, everybody. I do appreciate it. I hope that was useful and that the sound quality improved as we went on, and we look forward to doing one of these another time in the non too distant future. Thank you, everybody. Have a good day.